What's up, everyone? It's Scotty with Money Vesting. So Michael Burry actually tweeted a chart, I think a couple days ago, that I wanted to go over, and there was another report ran on Wall Street Journal that pretty much goes over a few charts of banks and how they're positioned at the moment, what percentage of their actual deposits are uninsured, and what their unrealized capital losses are right now at the moment with respect to their capital ratios. So this is going to be, a little bit of an interesting guide on which banks to really be paying close attention to and which ones are obviously in a much better situation at the moment. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon community is going to be down below. Consider supporting. We've got a little bit over 3,700 members there, and you can get access to all the alerts, trade ideas, and a lot of other private videos and benefits and different videos and lectures as well. So link's going to be down below. There is a 16% annual discount available till the end of this month with limited spots available. So again, link's going to be down below. So this right here is the chart that Michael Burry tweeted. And pretty much what this shows us is the unrealized losses as a percentage of their capital on the x-axis, and on the y-axis we've got the deposits that are over $250,000 as a percentage of total. So as you can see, that Silicon Valley Bank was all the way over here because they had unrealized losses that were significantly higher than their actual capital ratios, and the deposits that were above $250,000, or in other words, uninsured, were almost 100%. In fact, I think it was a little bit over 97 or 98% of deposits held at Silicon Valley Bank were uninsured. Then we've also had Signature Bank go under receivership because you can see it's in a very, very similar situation. It's got a lot of deposits that were uninsured, close to 80-85%, and it was also holding on to massive amounts of unrealized market losses. Now, theoretically, this should have never been a problem. This should really not have been a problem for these banks, because the idea for these banks really is to basically hold these securities till maturity. Of course, one of the most fundamental problems with Silicon Valley Bank and Signature and some of the other ones, one of the most fundamental banking 101 problems that they actually did was that they borrowed short and they lent or invested long, right? So they were borrowing on a very short-term basis because these are called demand deposits, right? So they're on demand. Depositors can come and demand their deposits at any time. That's why they're called demand deposits. And if the bank doesn't have the capital to meet those deposits, guess what's going to happen? There's going to be bank runs. And when they start happening, the companies, or in other words, the banks, will be forced to sell these securities and realize those losses. So they will go from unrealized losses to realized losses, which obviously becomes a much bigger problem that leads to bigger bank runs, that leads to more fear and more contagion in the market. So that was the dislocation there, obviously. And as you can see that right now, First Republic is going through something very similar. If you come over to their chart and take a look at how they've performed in the last, several weeks. In fact, even today, they were down 47%. So First Republic is certainly, possibly the next bank that's going to go under here, considering that it's obviously sold off from 110 down to as low as $11. So it's dropped about 90% in the last 13 days, in the last 2 weeks or so. And of course, today with the very brutal sell-off, 47%. Why? Because, well, First Republic is on that list. If you take a look at Comerica, which is, I believe, going to be CMA, that stock has also dropped pretty substantially. It's still down about 31%. In fact, it was much lower in the last few days. It was at one point down 56%, traded as low as $28 per share, in a very, very similar situation with about 70 to 75% of deposits are uninsured at that bank, and right now they're also holding on to some unrealized losses. So bottom line is, if you are looking at this chart, and again, I've already shared this in our Discord, but if you are looking at this chart and anything that's a little bit on this top right and possibly even bottom right quadrant is something worth a little bit more on the risky side. And the reason why top right quadrant most definitely is a little bit on the risky side. And by the way, USB is actually at right there. It's at like right at that line. It's in the bottom right quadrant. So really it's these four right here. And the reason why that's such a big problem is because if there are if I mean these are going down already, these are already failed banks, and the reason is because of the majority of the deposits being uninsured and a lot of unrealized losses on their books as well, right, in terms of market value. Now these banks, the bottom right, they're not a huge problem until there are bank runs. If there are bank runs, then these become a problem as well. In fact, I was quite surprised to know Bank of America is actually on that list with some heavy unrealized losses, and it is 50% uninsured. That kind of spooks some fears for me. But again, it's a systemically important bank. That's why you'll notice that those are the four that have been highlighted: Citigroup, JPM, Wells Fargo, and Bank of America, because they are systemically important banks. So, the Federal Reserve, FDIC, the Treasury Department, they're just not going to let them fail. They're just too big to fail. And they're, considered as the big four, right? They're the biggest banks in the US. So, but again, keep a close eye on those bottom rights, because if this contagion continues to ripple over, if there's any fears of potential bank runs, that's what's going to cause them to basically realize these losses, right? So if there is any fears on Wells Fargo, for example, or KeyBank, or any of these banks, what happens is runs start happening on these banks, and then they're forced to sell these securities at a loss, similar to what Signature and Silicon Valley Bank ended up doing. Now, this right here is another really interesting report, came out a couple days ago, the banking sector turmoil in charts. And what you'll notice is that things were much better in 2021. Things were actually not that bad in 2021. Silicon Valley Bank only had a negative 0.5% loss on their books, and they were still, I think, 80%, 85% uninsured. In other words, the depositors, 85 to 90% depositors were still uninsured. Still a pretty brutal situation, but they were not doing as bad on losses. This is going to be Bank of America. This is going to be JP Morgan. We've got Citibank, and we've got Trust Bank, Charles Schwab, TD Ameritrade. So, and then we also had some banks, for example, Wells Fargo was actually doing better. They were, only 50% of their deposits were uninsured, but at the same time, they also were making a profit on their actual investments, right? Securities and loans, they were actually profitable. They were green. Then comes 2022. If you come down and you see how the things change, almost all of them went underwater. All of them, right? So there's not even a single bank out there that was BNY Mellon, right? Doing almost, their investments and loans seem to be pretty much break even as of 2022. We got MUFG Bank, we got American Express National Bank, and we got Discover. Those banks seem to be pretty much at that 0% line, but most of them are underwater. And again, the report that we broke down, $2 trillion worth of assets are underwater in terms of mortgage-backed securities and U.S. Treasuries in terms of market value, right? If you mark to market them instead of book value, they are underwater. And Silicon Valley Bank, of course, all the way down here. So losses accelerated even more, and they became even more underwater with their securities. This is going to be BNY Mellon. This is going to be State Street. Again, fewer losses, but these are also companies that they don't have a lot of percentage of insured deposits. In fact, if you take a look at BNY Mellon, it's actually more to the right than Silicon Valley Bank, right? So if you do that, on the x-axis, it's more to the right than Silicon Valley. That means more deposits at Silicon Valley as a percentage are uninsured. So because the problem becomes if there are, bank runs on these banks, and they're forced to sell and realize these losses, right, and sell them at market value, whatever the market value is. And again, JP Morgan, Bank of America, Citibank, and Wells Fargo, all big four, are pretty much underwater. And if you take a look at when this problem really started happening, these are Signature and Silicon Valley Bank's deposit base. And you can see that every single quarter they were actually growing, right? 2021 was phenomenal for them. They were growing every single quarter. And then a decline started happening because, well, first of all, Silicon Valley Bank catered to technology companies in the first place. So that obviously was a big issue there. And as companies started to burn cash pretty aggressively because of the tightening, the financial conditions, and interest rates going higher, the Federal Reserve induced weakness in the economy really resulted in deposit outflows. And as that deposit outflows began over here, that's when these companies had to actually they were forced to sell their securities at a loss. And that's when all this started pretty much. So in other words, this is where we are. These are some of the banks to really be focusing on. I think Jerome Powell's speech obviously is going to be super important on Wednesday and how they're planning to contain this banking crisis. But some of the bigger banks, I don't expect them to fail. Obviously not, because they're too big to fail at this point, and that's something that I've already mentioned that I'm not, happy about, because all we're really doing is injecting more and more money supply into the economy, which is going to be inflationary in one way or another in the future. But definitely keep a close eye on some of these banks. Keep a close eye on this chart overall to see which can be the next falling or failing bank in the future. So hope you guys enjoyed this video and complete update. Let me know your thoughts down in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like, subscribe to the channel. Happy investing, and I'll see you all in the next video.